Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1618 and we are in a world where the Federal Reserve, yes, that corporation, notice I said corporation, not government agency, that runs our monetary system, they say that the outlook for 2021 has brightened, but, now this is interesting that they say but, interest rate is staying near zero. Ladies and gentlemen, kids, animals, whoever's listening, when you have artificially low negative interest rates near zero, that might be a good time to go long on real estate. I'm just saying. Think about it. So the Federal Reserve said on Wednesday that it will keep buying government bonds. Yes, they are the world's biggest investor until the economy makes, quote, substantial, unquote, progress. And nowadays, I don't even think it needs to make substantial progress. In fact, it's already made substantial progress, whatever that means. Why is that? Because, remember what I'm always saying, align your interest with the most powerful forces the human race has ever known. They want to benefit, and they want all their friends to benefit from the Cantillon Effect. This is yet another example of the Cantillon Effect, right? Because if they keep buying bonds, well, guess who also owns those same bonds that they're buying? They're supporting the market for the bond market artificially, and that benefits all the bigwigs. It benefits the biggest bond trading company in the world. What's that called? PIMCO. Their office used to be right down the street from our office in Newport Beach, California, and all of the big investors, all of the big companies that have done these bond issues, the government, of course, what does it do? It displaces money out of the government bond market because the Fed is in there buying the government bonds, so we don't have to rely on China. Why rely on foreign countries to buy your bonds when you can just have your own Fed buy them? I mean, this is just such a complex web of... it's an insider's game, folks. But the Cantillon Effect is definitely in play, and you can benefit because you have the proxy key to the Cantillon Effect, and it is your income property. Okay, according to the Associated Press, who crowned Joe Biden president without even knowing the election results. Folks, you can't even make this stuff up, can you? Okay, they are going to keep their key rate very low. So that pretty much says go long on real estate. But there's more. It means stock up on these cheap mortgages. Do you know the mortgage rate just dropped again? I just read an article yesterday that now again we have broken the record. We have fallen through the floor on interest rates to see the lowest mortgage rates ever. I did say ever. That's what I said. Okay, just so you know. Just want to make sure that's clear. Ever. Ay, ay, ay. This is just amazing. I mean, did any of us ever think we would see an environment like this? It's absolutely incredible. But the folks who have the income property and the folks closest to the money are just getting richer and richer and richer because they're all becoming multi-cantillionaires. Okay, the policymakers now foresee that the economy contracting at 2.4% this year, less than the 3.7% decline it had thought, that it had predicted just a couple of months ago, right? For the next year, they anticipate a rebound, okay, and they upgraded the growth forecast. And this is pretty incredible, folks. Are you ready for this? This is an amazing, amazing recovery. They upgraded the growth forecast from 4% to 4.2%. Now, what they're talking about there, of course, is the GDP. And they say by the end of 2021, the Fed expects the unemployment rate to fall below 5% from its current 6.7%. And that is lower than the 5.5% rate they had forecasted. So the Fed is getting optimistic, but at the same time that they're optimistic, they are not raising rates. Now, just think about that amazing forecast. A growth forecast of 4.2%. That is like, hey, is this the Roaring 20s? Maybe it's the Roaring 20s. Maybe it's the Roaring 20s. We will see. Remember, the Spanish flu that started in Kansas or Kansas City. I'm not sure which. Can't remember. So after the Spanish flu pandemic was over 102 years ago, we had the Roaring 20s. Now, I'm not saying we're going to have the Roaring 20s this time, because obviously things are quite different. But then 9 years after the Roaring 20s started, obviously what did we have? We had the beginning of the Great Depression. Well, we had a stock market crash, and then we had a Great Depression. But that's... it is interesting. It's the elasticity. Remember, it's the breadth of the difference from where we were to where we're going. And when people get the chance to get back into normal life, and I think they're going to be looking at life with somewhat of an attitude of, hey, life is fragile. Let's live it up a little bit. Now, I'm not saying that's good. I'm just saying I think it's the way people are, right? Because they've sort of got that rubber band concept going on. So pretty interesting times. And by the way, I was looking at another article today, a report that said there are bidding wars for more than half of all listings in numerous markets across the U.S. Not every market, because then you'd be talking about 400 MSAs almost, and 3,100-ish counties. So not necessarily every market, but bidding wars on more than half of all the main markets in the country, right? So it's absolutely unbelievable to report on this stuff nowadays. It is truly, truly an amazing, amazing market we're in. And it is propped up by a bunch of, smoke and mirrors, house of cards, whatever you want to call it. But that's nothing new, folks. That is nothing new. That's been that way for decades, if not 100 years since the Fed was created. And it's true of every economy in the world. It's not just the U.S. economy. So that's the way it is, as the famous newscaster used to end the broadcast. That's the way it is. Okay, so that is the way it is. Let's get to Adam, who is back with us today to talk more about all of these issues and more. So here we go. You
All
have
right.
another slide that I want to hear you talk about. You showed it for a second. Yeah.
So then I went and I said, if we're waiting until 2023 for inventory, what are we? And we discussed this a little bit the last time. What is going on in the markets we're in now? And how will that impact your investing in the future. So I went to the FHFA's website and looked at their home price indexes that they have and saw how our markets are doing. They had the top 100 MSAs in terms of appreciation, I found from the last year, and these are some of our markets and how they're doing appreciation wise over the past quarter and the last year. So I want you to know this 9% in Atlanta is the worst number I'm going to show you today. So the Atlanta market, where we have some properties, not a ton anymore, but some, is up 9% over the last year and 3.3% over last quarter. The U.S. as a whole appreciated 7.8% over the last year and 3.1% over the last quarter. So these are markets that, we obviously, as I just said, we don't invest for the appreciation. But if you were to get in today, the likelihood is you're going to see something similar to this for at least the next 6-12 months, because the Fed's flat out come out and said, hey, we're not going to touch rates. And if rates stay this low and the inventory stays this low, there's only one way prices can go right now, and that's in the upward direction.
Yeah.
And so Cape Coral, Fort Myers, where we also have properties, 9.5% appreciation in the last year, 4.2% in the last quarter. Where else? Jacksonville, Florida, 9.7% over the last year, 2.7% over the last quarter.
So,
Birmingham,
Adam, when you look at appreciation stats, it's really important to just point out to people the incredible power of leverage. If you want to buy a mutual fund, or you want to buy stocks or bonds or cryptocurrency, you've got to put 100% down.
Yeah, they don't do loans for that.
There's no leverage, okay? With real estate, let's just do the simple, you can't do this on an investment property, but let's just say it's 10% down for simplicity's sake, okay? Cut it in half for an investment property where you're putting 20% down. And by the way, you can put 15% down sometimes on investment property. So, but let's just go with 10 for simplicity, just for concept. 10.2% turns into 102% gross return on investment. 9.7% turns into 97% annual gross return on investment. Understand that is simplified. It doesn't include tax benefits or positive cash flow that makes these numbers better, okay? But what makes it worse is if you just wanted to take 1 year and you said, okay, I'm going to make that appreciation, sell it a year later, well, you're going to have closing costs, and that's going to eat up your return. So I just want to say on balance, understand that. But again, the best thing to do is be a long-term buy and hold investor. So go ahead.
Yeah. So then we also have Birmingham, which has got the 10.2% over the last year, 4.4% over the last quarter. That's number 19. And we're not even done. We're continuing to go up. Memphis has a 10.4% over last year and 6.4% over the last quarter. We talked about Memphis 4 or 6 weeks ago whenever I was showing kind of why that city's appreciating.
I had the thought of selling my Memphis properties from time to time. No way.
Yeah, so you've got that up 10.4%. And Jason, do you want to guess which market we have that is the absolute best in appreciation?
I'm going to say Atlanta.
No, we already covered Atlanta. That was 9.
Okay.
That's 9.0.
It gets better?
It does get better.
10.4? No.
It is our newest market.
Oh, Charlotte. Yeah.
Charlotte is 10.8% over last year. It is the number 9 out of the top 100 metros. 10.8% over last year and 3.8% over the last quarter.
Wow, that's just incredible.
So I say this not to say you're guaranteed 9, 10, 11% if you go into these markets, but this is flat out happening right now.
Yeah.
This is the economic situation. We have the COVID crisis somewhat getting in the rearview mirror. The economy is picking back up. Home prices are appreciating. And if you're going to get in, if you're going to invest, if you're going to increase your portfolio, if you wait until 2023, even if these things just go up 10% over the next year, even if properties drop 20% in the meantime, you're not getting that much of a benefit from it. Maybe it goes down to 95% of what it is now whenever it drops 20%. But you're missing out on a ton of possibility in the next 2 years with all of the benefits that are available.
You really are. And I just wanted to address a couple things I've been putting on the screen. Number one, we're talking about Charlotte. You can check out our Charlotte investing webinar where we do teach a little bit in there, and then we go into specific properties and brand new construction in Charlotte, North Carolina. I love this market. I've made good money there myself as an investor. And also, we've helped hundreds of clients over the years invest in that market. So that's jasonhartman.com/Charlotte. And then also our advanced asset protection and estate planning webinar. I've been showing that on the screen. That's jasonhartman.com/protect. So you can check those out and get a lot more information with any of those. It's amazing, Adam. It really is. And I think it deserves a sound effect. Cha-ching.
Yep, definitely. So that's what I got for you today.
Oh, okay, that's it. So
that's my lecture.
You want to grab a couple questions and comments?
Yeah, sure. There's a couple here. Like, what do you think of Cache County, Utah, or the San Antonio market? I don't know a ton about those markets, honestly. I mean, I know San Antonio. It's an hour and a half south of me. But like we've talked about with Texas before, you're going to have to really dive into it. Texas requires about a 0.9 to 1% RV ratio just to make the property taxes work.
To offset the higher property taxes.
Yeah, because as a non-home owner occupied, owner, they're going to be high.
Yeah, so, when you're an investor, they charge you a higher tax rate.
They cap they don't cap the amount they can raise the value of your land, of your property. So it can get a little rough. But if you can make it work, then Texas is a good place to invest. It just can get tricky as Texas appreciates. You have to it can lend a couple of rough years, or not rough, but not as good years if your rent doesn't keep up with your value as much. So
yeah, sure. I want to address a comment here from CV. And CV says U6 unemployment is around 15% or more, according to George Gammon. Well, I don't deny that the unemployment stats are understated. There's good reason. Just like the consumer price index, the CPI, which is the measure of inflation, is also understated. It's all a big scam, folks. I mean, no one will deny that, okay? They manipulate the statistics. Yes, that's the way the world works, unfortunately. But the right question to be thinking about, CV and everybody else, is compared to what? Remember, we're only comparing the stated official unemployment rate today and the stated official consumer price index today to what it was before, when it was also manipulated. Okay. Now, I know what you're going to say if you've really taken a deep dive into this stuff. You're going to say, when it comes to inflation, at least, and by the way, I had the founder of shadowstats.com, John Williams, on my podcast, and he keeps track of this stuff, beyond what the government tells you. But I think he's wrong in some ways too, because one of the big arguments is these guys will say, and George will say this too, frankly, is that before 1980, if you just calculate inflation, for example, not unemployment here, but inflation, the way they calculated it before 1980, it would be much higher than it is now. Well, here's the problem. Nobody ever asks. You say the inflation stats are wrong today, and I agree with you. I agree. They are manipulated. But they were also manipulated back then, okay?
Not new.
To say that the way they did it before 1980 was correct either, okay? You can argue with that. And when you look at like Shadow Stats and you do his inflation calculator, I'm a paid subscriber to Shadow Stats, okay? I pay for the membership. And that gives you access to some of his calculators. And I won't even quote his stats because they're so ridiculous. They're like insane. I mean, Adam, if you want to take a couple of these questions, I'm going to find the paper because I have it around here somewhere. So, Adam, it's all yours.
All right. So, CV, you talked about house hacking in places like Queens, New York City. A millennial and the home prices are sky high. I can definitely understand that. You're looking at houses in the $850,000 range. 30-year fixed rate at 2.75% is around $2,700 monthly mortgage. And property taxes around $600 per month. So you're looking at $3,300 all in. And you can rent it out for $2,100 a month. And the tenant would be paying your equity, and you'd have a lower cost of living. Even if the housing prices potentially fall, the tenant would pay your mortgage. Well, your tenant wouldn't be paying your mortgage at $2,100 a month. You'd still be paying, at least $1,200 a month to live in the property. Now, house hacking has its places. If you just really want a property and want to get in there, and you're okay with that, then $1,200 a month to live in Queens might be worth it to you. You just need to look at what you're losing, buying that property. I don't know what you'll have to put down, if it's 5%, 10%, and what you can do with that money if you don't put it there, and the benefits you could get tax wise and for the future. So, living for $1,200 isn't a bad deal, but it's just, what else could you do with your capital is the big question you need to ask.
Well, let me just share with you the difference on the Bureau of Labor Statistics, the BLS, and the shadow stats inflation calculation. I'm going to hold this up to the camera in a moment, okay? But because I've got it on good old-fashioned paper. I printed it out. I couldn't believe it. So it was so amazing to me that I had to print it. What I was doing is I was doing a bunch of calculations for the presentation that I gave yesterday, and I was calculating how real estate has actually, from a payment perspective, a monthly payment perspective, it's become cheaper and cheaper and cheaper over the years when you adjust for inflation, prices, and interest rates, and mortgage rates, I should say. And so I was looking at the shadow stats stuff, and I was going to use their numbers. I was tempted, but I decided not to because they're so outrageous. Here's how outrageous the numbers are. Okay. What I did is I plugged into their inflation calculator that I pay for to be a subscriber to this. Okay. $100,000. Okay. So a $100,000 mortgage, for example, in 2006 was worth how much in 2020? Because this is an example of what I call inflation-induced debt destruction. So look at this. According to the BLS, the inflation has affected that mortgage by $27,000 and change. According to shadow stats, you ready? Here you go, Adam. Look at this. Now, when I hold this to the camera, I won't be able to read it, so maybe you can read it. $347,000, I think that says.
Oh, sorry. It was 359,000, I believe, is what it became. $349,000.
So that's the difference. Now, if you think that's reasonable, I don't think so, as much as I'd love to believe shadow stats. And I do believe that it's manipulated. It's just not manipulated that much.
So, Eccentric, you say there is talk of a dark winter and the Great Reset. In order to usher in this global reset agenda, the markets will need to crash. How are you going to protect yourself from this Marxist agenda? I think we've been seeing that it's very difficult to try to force an entire economy to crash. We shut down the world economy for months, and it's bounced back. So it's going to be pretty tricky. You're saying the Marxist professor Richard Wolff predicts we will see the worst crash of our lifetime. As we know, we are entering the Marxist era. There may be some truth to his prediction. You do have some people promoting it, but the mainstream, the vast majority, the people who are making our laws, that's not what they're saying. That's not what they're doing. So I think that's fear mongering in a lot of ways, but I don't see that happening.
Yeah. So Richard Wolff, when I interviewed him, the Marxist professor Richard Wolff, I just could not win at him. I interview this guy. I obviously don't agree with him. I'm the last person who's a Marxist. Okay, but his fans, were commenting on that interview saying I was such an idiot, right? And then my fans were saying I was glorifying Marxism. How do you win? How do you win? I tell you, it's just some days you just can't win, can you?
All right. Well, one thing to keep in mind, and Jason, you and I were talking a little bit about it before we even started this, is you have to look at the past history of the United States and see that we find a way. And it's very hard to keep our economy, our people down. Yeah. You look at, what's happened in the last year and where we are now, it's pretty incredible. We were a high-flying society, doing great. We shut everything down. We stopped the world, we stopped the country, we put people out of work. And 8 months later, we're bouncing back. Yes, there's still some people who are hurting, but by and large, the rebound we've had from that is incredible.
It's amazing.
And that's with parts of the economy still being shut down.
Right.
I mean, when these vaccines hit and we're able to, reopen all of the big cities, all of the, industries that are being shut down now, I mean, there's not going to be a ton of pent-up demand for people to go do things, but that demand gets unleashed. Unless something drastic happens elsewhere in society, I think we're going to be back to where we were.
I don't know if we'll be back to where we were. I've predicted the modified square root, meaning, people will reassess values and we'll move into a bit of a smaller economy. We'll wake up to a smaller economy, but that's not necessarily that bad. And I might be wrong because, Adam, what's really important to remember, and I've got a podcast coming up on this topic, is that after the 1918 Spanish flu that killed between 50 and 100 million people, what did we have? We had the Roaring 20s. And, the concept psychologically, which is really important on that, is that, look, when people are, shut inside, when they can't do what they want, when they're not spending money, as soon as they get a hold of some, they just want to kind of bust out and go and, live life. And they also feel maybe somewhat fatalistic that, hey, life is short. We just had a tragic thing we went through, and I survived it, right? Maybe I should live it up a little. And so there is some of that, and people spend following that mentality. So after the 1918 Spanish flu, we had the Roaring 20s. Okay, go and watch some movies and videos about that, and see how life was during the Roaring 20s. It was a pendulum. The pendulum is always swinging, and so we're at one part of that pendulum now. It's uneven, not the whole economy, but certainly parts of it. Certainly some people, others are doing great, some are suffering. It's very mixed, I get it. But the pendulum is always swinging back and forth.
So CV, you're asking if there are any places in Texas where it's a good place to invest. We're looking at Texas markets right now. Last I heard, we were looking in New Braunfels, which is a kind of a medium-sized city between just a little south of Austin, yep. Which is it's a great place. And if we can make the numbers work, it'll be a fantastic place to buy. Honestly, I'd probably go buy there. But
Texas has become a little bit expensive, folks. I mean, we've helped hundreds, probably thousands, I don't know, hundreds at least, of investors invest in all the big Texas markets, whether it be Dallas, Austin, San Antonio, Houston. But it's become a little bit priced out, and we've got to be in those markets where the cash flow is good and those rent to value ratios are really good for our clients that already own Texas properties, like myself. Okay, that and I bought them years ago. I'm just milking it, and it's fantastic. But there's a difference between entering a market today and entering it back then when your cost basis is different, right? So,
Austin was the number 3 market, I believe, on the list. It was 11.3% appreciation year over year. So it was, it's huge. In regards to, you ask CB, what cities are good cities to invest in at the moment? I mean, just go to jasonhartman.com/properties. Those markets are good. We can help you find properties there. You could go to jasonhartman.com/ask. You can send any questions our way and somebody on the team will help you out.
Yeah. And a lot of times we answer those questions on the podcast too. So, definitely the Creating Wealth podcast is what you want to be listening to 5 days a week, Monday through Friday. Well, Adam, let's wrap it up. Thank you so much to Adam, and thank you to all of you watching. We really appreciate your fantastic comments and questions, and appreciate you viewing and telling your friends about us. And be sure to click that like button before you go. It helps us with the algorithm that runs the world, unfortunately, but that's the way it is. We will see you later today on the podcast. And we do that 5 days a week. So be sure to check out the Creating Wealth podcast if you're not already subscribing. Adam, thanks so much. Thanks, everybody. Have a great day. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.